The Farmland Cartel. Why Bill Gates and Vanguard are the new feudal lords of the American diet. The auctioneer talks fast. A fourth-generation farmer squeezes his hat. The winner isn't a neighbor. It's a numbered LLC. The family leaves with a check and a hollow look. 6 months later, that same county sees lettuce at $14. People blame gas, weather, greed, anything but the deed. So here's the question. When did dinner become a line item in a billionaire's portfolio? How did tech money and Wall Street end up deciding what grows, where, and for how much? Stick with me. We'll trace the money, expose the playbook, and show real exits. To understand why, we need to go back. The great land grab begins. Get this, farmland got a new nickname, gold with a coupon. Why? Because it pays you twice. You get annual cash from crops or rent, and the dirt itself tends to rise over time. For investors hunting steady yield, that pitch hits like caffeine. Then the world broke in the late 200s. After the financial crisis, rates went to near zero. Bonds paid peanuts. Pensions, endowments, insurers, big pools of money, still had to hit 7 or 8% targets. So they started shopping for real assets that didn't swing like stocks and came with inflation protection. Timber, toll roads, storage, and dirt. Meanwhile, something else was happening. Food prices were bouncing, climate shocks were louder, and everyone suddenly cared about inflation hedges. Farmland looked calm on a chart. Low correlation to stocks. Steady returns built on people needing to eat every day, no joke. On paper, it was boring in the best way. The sales deck wrote itself. Farmland delivers mid-single-digit yields, plus land appreciation, with less volatility than equities. Add moderate leverage, and pension math starts to smile. Trust me on this one. Once the consultants bless an asset class, money pours in. And money did. But here's where it gets messy on the ground. USDA data shows family farms still dominate by count, sure, but production is shifting up the ladder. Between 2022 and 2023, non-family corporate operations grew their share of the value of production from about 11% to about 17%. That's a big jump in 1 year. It means fewer, bigger players capturing more of what your grocery bill pays for. Now remember, this isn't just about who owns the tractor. It's about who owns the land under it. There's a quiet split between operator owners and non-operator landlords. More acres are worked by tenants paying cash rent to owners who never touch soil. When the owner is a fund, those rent targets are set by cap rates and spreadsheets, not by rain and neighbors. Enter the vehicles that make this easy. Farmland funds and syndications promise access to institutional quality, acres. REIT-style structures bundle fields into a yield product. Numbered LLCs show up at courthouse steps and online auction platforms. The names are bland on purpose. The beneficiaries are not. Why does Wall Street love dirt? 3 reasons. 1. Inflation hedge. Food prices move with input costs and weather, so over time, rents and crop values tend to track inflation. 2. Diversification. Farmland returns don't dance to the same beat as tech stocks. 3. Leverage. Land is bankable. Cheap debt in the 2010s juiced returns across the board. A 2% loan on an asset yielding 5% looks like free money. Until it isn't. And that until matters. Because every quarter, funds owe investors a story. Stable yield, growing NAV, mission words like sustainability and stewardship. To hit the numbers, they standardize leases, push capital improvements that boost appraisals and target rent reversion at renewal. Sounds harmless. On a balance sheet, it sings. On a farm, it squeezes. Meanwhile, pension money is now looped into your dinner. The same retirement plan that owns your index fund also owns pieces of processors, retailers, and sometimes the fields themselves. Your future benefits depend on margins that show up as higher shelf prices and tighter farmer budgets. That's the quiet trick. Your savings account is paying you with your grocery bill. To understand how fast this changed, let's rewind to the Rate Zero era. Consultants built real assets, sleeves for every big plan. Infrastructure, real estate, natural resources. Farmland slipped into that basket as the essential commodity with income. Capital calls stacked up. Managers needed acres fast. They hunted scale, big blocks with water, logistics nearby, and willing sellers. Who sold? Aging operators with heirs who'd left. Families tired of drought risk and debt. Folks who saw a once-in-a-lifetime price and took it. No shame in that. Been there, done that. When a bid clears your mortgage and funds retirement, you take the life raft. But scale buyers don't just take land. They take price discovery. When a fund sets a floor at auction, neighbors have to match it or walk. Cash rents follow those comps upward. Input dealers and equipment lenders see safer clients with institutional backing and adjust terms. Local cafes hear fewer harvest jokes and more talk about lease clauses. Here's where it gets crazy. The marketing says stewardship. And look, some owners do invest: tile drainage, pivots, cover crops, lab soil tests. Those can help yields and resilience. But the math doesn't care about soil health unless it shows up as rent growth and appraisal upticks. In a down year, the spreadsheet doesn't feel hail. So the central question lands hard. Who now controls where calories are grown? If an asset manager sets rent targets from a high-rise, and a processor dictates grades, and a retailer squeezes shelf space, the farmer becomes a price taker sandwiched on all sides. The land carries the weight, and the contract carries the risk. While that was happening in New York, county seats felt quieter. More mailboxes with LLC names. More trucks without farm logos. More decisions made on conference calls. The land didn't move. The center of gravity did. We're about to put names and faces on the new landlords. Because it's one thing to say, institutional capital. It's another to see the map and the signatures. This was the moment everything changed. When dirt turned into a financial product and dinner turned into a coupon clip. The Bill Gates footprint, fact versus hype. Unknown to them, across town, a different kind of buyer had already circled the map. The signatures didn't say Bill Gates. They said Cottonwood AG Management. They said Cascade Investment. Same empire, quieter door sign. Here's what's on record. Gates-linked entities hold roughly 275,000 acres across about 18 states. Spread out patches, not one giant block, and almost all of it sits inside layers of LLCs under Cascade, managed day to day through Cottonwood AG. That structure isn't illegal or even unusual. It's the standard way big money buys land without plastering names on the mailbox. The public line from his camp sounds calm. Long-term stewardship, soil health, sustainability, stable returns. The idea is, if you hold land for decades, you care about soil like a factory owner cares about machines. You maintain it. No quick flips. No strip mining the dirt. And look, some tenants will tell you Cottonwood funds drainage tile, new pivots, better roads, even trial cover crops. Upgrades that stick around. But critics see something else: consolidation power. Not just acres. Control points. When you pick locations near processing plants, rail spurs, and cold storage, you aren't just buying ground. You're buying leverage over what moves, when, and at what grade. Maps show large blocks in Louisiana, Arkansas, Nebraska. Row crops, rice, potatoes, close to the pipes that feed America's plates. What nobody knew at the time, when Cottonwood bids rolled in, was how the lease would feel 2 seasons later. The standard deal is simple on paper: cash rent, multi-year term, clear rules on practices and capital projects. The clauses matter. Some give the landlord veto power over rotations. Some require certain input programs. Some say who pays for lime, for wells, for repairs after a storm. On the spreadsheet, it's risk management. In the cab, it's a cost you don't control. Stakes, right? For tenants, the risk is losing the ground that holds their whole operation together. If you farm 8,000 acres and 2,000 of that is a Gates parcel, you don't bargain hard when renewal hits. For neighbors, a deep pocket landlord sets the floor on rents. For towns, it shifts where profits land when the crop sells. That's why people care. It's not envy of the billionaire. It's fear of being priced out of your own history. Action. In one county, a Cottonwood-controlled LLC wins a cluster of tracts by paying above the local comp. The seller, an aging family partnership, gets a life-changing price. The tenant stays on with a formal lease and new capital work. Ditch rehab, a pump upgrade tied to an energy contract, and a data platform to map yields. The first season goes fine. The second season brings a dry spell and higher input costs. The rent doesn't flex because it's set to a cap rate, not corn futures. The farmer squeezes. The owner's appraisal still moves up because the land now has irrigation and documented productivity. Impact. Right away, nearby landlords call their tenants to discuss rents. Brokers update pitch decks with the new sale price per acre. Local lenders treat the new rate as normal. Over a few years, the whole rent curve lifts. Cottonwood's parcels aren't all of it, but big anchors pull the market. Now, facts versus stories. It's not true that Bill Gates owns most American farmland. He's not even near the top owners by volume when you count timber and ranch empires. It's also not proven that he's out to corner seed or water through these land buys. Gates has stakes in agri-tech grants and climate funds, yes, but Cottonwood's leases look like many other institutional leases. Where critics have a point is concentration risk. When a few very large buyers set professional terms, small operators bend to those norms even on land those buyers don't own. Let's talk clusters. Why Louisiana and Arkansas? Rice and potatoes love water and infrastructure. These states have irrigation history, mills, and barge access. Nebraska: corn, soy, potatoes, feedlots, rail, and big processors in driving range. Being near a plant reduces basis risk, smooths logistics, and helps hit quality specs. For a landlord, it also means more tenant candidates with scale. If one exits, another can slot in. Tenant dynamics matter more than the owner's name. Cash rent is stable for the owner, risky for the farmer. Flexible leases share upside and downside, but many funds prefer fixed numbers they can hand to investors. Control clauses can be helpful. No-till, cover crops, nutrient plans, but they also lock the farmer into input bundles and insurance rules tied to the owner's risk model. And if capital improvements are landlord paid, expect that cost to show up in higher rent next term. Nothing is free. Here's a micro-story. A grower in the Red River Valley signs a Cottonwood lease on a potato rotation. The contract requires specific storage upgrades and a third-party soil test each fall. The landlord pays half for a new forced air system. Yield jumps. Great. Then storage power costs spike the next year, and a hailstorm bruises a late field. The processor downgrades a chunk to off-grade. The cash rent bill still arrives on time. The farmer makes it, but trims labor and delays a planter purchase. The landlord's report shows enhanced asset with proven yield response. So, hype versus reality. The hype says one man now dictates your dinner. Reality says one network of capital, with Gates as a visible node, sets professional standards that tilt the field. It's less a cartoon villain, more a machine with clean decks and a quarterly call. This decision would matter for decades because it normalizes farmland as a portfolio line. And once land becomes a product, more money follows. Which brings us to the bigger web, owners who don't just touch land, but also the seed companies, the tractor makers, the packers, and the stores where you tap your card. The Vanguard-BlackRock web and food. From the Gates map, zoom out. The bigger shadow isn't a person. It's a set of index funds. Vanguard and BlackRock don't run tractors. They own slices of almost every company that sells to farmers, buys from farmers, and rings up your groceries. Not a conspiracy, just passive money at industrial scale. Start with the iron. Deere and Company. Top shareholders. Vanguard and BlackRock funds sit near the top across multiple share classes. Same story at CNH and AGCO, but Deere is the bell cow. When the price of a new combine jumps, a chunk of that profit flows into the same funds that sit in your retirement account. You feel that on the loan. You see it again in your 401k. It's the loop. Now make it personal. When your grocery bill rises and those companies hold margin, your index fund quietly collects the dividend. Your retirement account looks better because dinner got pricier. That's the passive loop. You pay more at checkout, the companies report higher cash flows. Index funds pass those gains into your 401k, and you feel a tiny win that came from your own wallet. Now the chemistry. Nutrien Corteva, Bayer's crop science arm through ETFs. Big buckets of broad market, money hold the top lines on the register. Fertilizer spikes, seed trait fees tick up, margins expand. Those index funds capture the lift without a phone call, because they don't need to call. The structure gives quiet power, steady votes, board influence through policy, and a bid under the stock that rarely leaves. Then meet Tyson Foods, JBS through foreign listings in global index products. Hormel, the same names appear on the holder lists. If packer margins widen while cattle checks lag, who benefits? The holders at the top, which include the same passive giants. You pay it at the deli. They book it as tracking error well managed. Your 401k smiles while your sandwich costs 50 cents more. And retail. Costco and Walmart anchor so much of the weekly cart that they might as well be public utilities for food. Vanguard and BlackRock are again top holders. slotting fees, private labels, supplier terms. Those levers shape which brands win eye level and which farms survive a contract. A 2-cent squeezed on a can line doesn't look like much on a PPT slide. Across a nation, it's a rent stream. Across your month, it's the gap you fill with a credit card, even as your retirement balance inches up. Here's where it gets crazy, in a quiet way. Passive flows don't chase stories day to day. They buy whatever the index says, whenever your paycheck hits, forever. That means control without intention. The funds don't decide fertilizer prices. But when they're the largest owners of the fertilizer company, the tractor maker, the processor, and the retailer, the chain gets sticky. Pricing power can move down the line and stick at checkout because everyone upstream reports to the same shareholder base that wants stable, rising cash flows. Stakes. For households, this means your grocery bill dances to a rhythm set by a handful of firms whose biggest owners never sell unless you retire. And here's the kicker. The same paycheck that funds your 401k also funds your food bill. Paycheck in, index buys shares, firms protect margin, prices round up, dividends flow back into the same account. Closed loop. Action. Picture a season when nitrogen prices spike. Nutrien's guidance rises. Deere updates order backlogs. Tyson talks throughput and disciplined pricing. Costco touts member value while pushing suppliers on costs and growing its private label. Vanguard and BlackRock vote proxies across all four, guided by stewardship policies that prioritize long-term return and risk controls. None of this requires a smoke-filled room. It's policy, not plot. Impact. Immediately, farmers face higher cost per acre and can't pass it on. Processors hold their margin with contracts and scale. Retailers round prices and shrink packages. Consumers pay more for less. Pension statements look fine. The loop tightens. Your savings look steady because your staples got pricier. Now Farmland fits into this web as the real assets sleeve. BlackRock sells agribusiness exposure through ETFs. Vanguard funds own REITs and public AG names. Some institutions place money into farmland partnerships that target cap rates like an apartment building. Tax-advantaged structures help pass dividends, including from REITs, back to funds. Ordinary people end up owning a thin slice of the dirt, the diesel, the DNA, the slaughter line, and the scanner, most without knowing it. You're both the shopper and a tiny landlord, paying yourself with your own cart. What nobody knew at the time, as passive grew into a giant, was how it would shape behavior. When managers know their top holders won't sell on a bad quarter, they lean harder into price discipline. Discount wars fade. Capacity gets rationalized. Earnings smooth out. That's great for charts. It's rough on dinner. Here's a micro-story. A small salsa brand hustles into a regional Costco. Great win. 6 months in, the buyer asks for a bigger promo and a tighter price. Freight costs ate the margin last quarter. Tomatoes were high. Glass jumped. They try to push back. The shelf says no. The buyer points to a private label line with similar specs and a better landed cost. The brand survives, but switches to cheaper paste, cuts QC hires, and praise. The shareholder letter at the top celebrates private label penetration and supply chain efficiency. Your fund owns a slice of both companies. Your cart funds both outcomes. This was the moment everything changed because control turned horizontal. Not one company, but a lattice of holdings that run from field to fridge. You don't see it on a label. You feel it when every aisle tells the same story. And your retirement account nods along because that story pays a dividend. How farmland became a financial product. While that lattice of owners sat over the aisle, something quieter clicked into place on the dirt itself. Farmland stopped being just a deed and turned into a product you could slice, price, and sell. That shift didn't happen in a headline. It happened in term sheets. Start with securitization. Managers built funds that buy fields like apartments. They pool parcels across states, set a target yield, and mail investors quarterly distributions. Syndications chop a farm into units so doctors in Phoenix and dentists in Des Moines own a pivot in Nebraska together. Then came crowdfunding pages, glossy photos of soil, and token slices of an acre on chain. Same idea, new wrapper. Appraisals became the metronome. A field isn't priced on romance. It's priced on income. So owners set rent targets to hit a cap rate, say 4.5%, then back into what the tenant must pay. If local cash flow won't stretch, they tag on value-add projects, tile, pivots, drain fixes, roadbeds, and power hookups. Each dollar that boosts net operating income nudges the appraisal up. The report lands. The fund marks higher. The deck sings. Debt slides in under that. In the 2010s, cheap loans turned dirt into a lever. Stack a 2 or 3% mortgage under a 5% yield, and the spreadsheet throws confetti. Managers layered senior bank debt, then sometimes mezz loans from insurance firms. Interest-only years kept distributions smooth. Nobody worried about rollover risk because rates would stay low. You can guess how that story turns when the hikes hit. Insurance and derivatives rounded out the package. Crop insurance hedged. Catastrophic loss. Some funds used futures to lock prices on corn or soy exposure tied to flex leases. Water rights moved from footnote to headline. If an acre came with senior water, that became a yield enhancer all its own. In dry basins, an old ditch right could swing value more than soil class. So acquisition memos started with water maps, not romance about sunsets. Here's the private equity playbook in farm boots. Buy at scale where you can standardize. Create a brand around institutional stewardship. Roll single farm into operating clusters. Install common leases with renewal escalators. Centralize purchasing for seed, fuel, and custom work to shave costs. Add tech, yield maps, soil labs, remote sensors to prove operational excellence. Then exit to a bigger fund or a public vehicle at a fatter multiple because the income now looks like a bond. Stakes. For farmers, this flips the script. The land isn't a neighbor's legacy. It's a cash flow target with audit trails. Leases get thicker. Clauses dictate tillage, rotations, fertilizer plans, even data sharing. If the weather wrecks a season, the rent number still needs to match the model. Miss it, and renewal feels colder. Action. Picture a 5,000-acre package carved into 3 funds. Each parcel gets a new well, variable rate irrigation, and a remote pump meter tied to a portal. The landlord pays for gear. Great. The lease then bakes in a 5-year step-up tied to improvement ROI. The appraisal captures upgrades. The fund raises a follow-on. Investors clap. The farmer nods because he needs the ground. The math is tidy. The mud is not. Impact. Immediately, comps climb. Nearby sellers see the new cap rate and push for that price. Banks adjust collateral values and lending limits. County assessors notice. Property taxes tick up. Cash rents drift higher across the whole township, even on fields the fund doesn't own. That's how financial products leak into real life, through comparable sales, lender models, and boilerplate leases that become the default. Now rate shock. When cheap debt rolls to 6 or 7%, the bond math breaks. Managers have 3 options. Sell parcels and realize gains. Cut distributions to investors. Or push rent and fees harder to keep the yield line straight. Guess which choice shows up in a tenant's mailbox first. In light of current financing costs, market rents now reflect. You've read this letter, right? What gets left out are the external costs. When leases chase cap rates, rotations can get shorter. Soil rests less. The safest move is often the most extractive. Heavy traits, heavier chem, short-term yield. Not always, and plenty of managers do push cover crops and no-till. But the appraisal clock doesn't measure worm counts. It measures net income. Meanwhile, packaging never stops innovating. Some managers bundle farmland, water shares, and solar easements. They pitch stacked revenue and resilience. Insurance carriers design bespoke policies for those stacks. Derivative desks sell weather hedges tied to degree days. Each layer smooths the chart a little more. Each layer adds a fee. Here's a micro-story. A fund buys a vineyard block with junior water, slaps on drip, inks a contract with a mid-tier winery, and finances the deal with floating-rate debt. Year 1, perfect. Year 2, allocations drop. Pump hours shrink. The contract has a quality clause the fruit barely misses. The rent still needs to clear because the fund's investor letter promises stable cash yield. The tenant eats the gap. The fund adds a paragraph about climate challenges managed within expectations. So yeah, farmland became a financial product. Not evil by design, just engineered to feed a portfolio. And when you engineer anything for a spreadsheet, the dollar spreadsheet starts calling the shots to their yield. So let's follow a single dollar from your cart. You grab milk, bread, chicken lettuce. Tap your card. That dollar doesn't just disappear. It splits. A slice covers land rent. Another slice pays seed, fertilizer, chemicals, diesel. A slice goes to transport and storage, trucks, rail, cold chain. Then processors take their cut to clean, can grind, or pack. Retail marks it up to keep lights on and meet margin targets. What's left for the farmer is whatever the system didn't already claim. The middle is where it tightens. Processors and packers sit between thousands of farms and a handful of huge buyers. They write the specs, set the dock times, score the quality, and discount fast when things aren't perfect. That squeeze pushes risk back toward the farm and pushes price up toward the store. The middle isn't evil. It's just concentrated, and concentration loves steady margin. Here's where rent sneaks into your pantry. Many institutional leases have escalation clauses. 2 or 3% a year, sometimes tied to CPI, sometimes just fixed. So per acre rent rises like clockwork. That cost doesn't stay on the farm. It moves into crop bids, processor quotes, and finally that shelf tag you stare at. You think, wow, everything's up. A quiet line in a lease did part of that. Hedging shows up too. The big firms use futures and options to lock prices, manage basis, and smooth revenue. That calms their earnings calls. Farmers hedge as well, but they're hedging around cash rent, input pre-buys, and contracts that can't flex. When markets swing, the basis might widen, the hedge might undercover, and the farmer eats volatility while the processor books disciplined pricing. Shrinkflation and premiumization add gloss to this. You've watched packages get lighter. You've seen artisan, protein, zero sugar sell at a bump. Investor decks defend it. Higher unit economics, trading the consumer up, protecting margins in inflationary times. The farm gate price rarely rises in step. That $2 health halo doesn't land in the field. It lands in EBITDA. So who actually earns the spread? Owners of bottlenecks win first: seed traits, fertilizer nodes, slaughter capacity, cold storage, and national aisles. Landlords with fixed rents win second. Their checks clear even when yields wobble. Transport and insurance get paid. Retail holds margin with fees, loyalty data, and private labels. Farmers get what remains after weather, grades, and contracts take their tax. Consumers pay with smaller packs and roundup pricing. Let's put numbers without the math headache. Say an acre of corn costs $900 to plant and grow when you add seed, fert, fuel, chemicals, labor, and machinery hours. Add $250 cash rent. If weather is kind and prices hold, it works. If rain stalls and fertilizer was bought at the top, the margin vanishes. None of that changes the processor's fee or the retailer's markup. Your dollar still travels the preset road. Meanwhile, your retirement money shows up in the yield on the other side. A farmland fund pays its investors a quarterly distribution. A REIT pays dividends sourced from rent. Agribusiness stocks pay dividends from stable margins. Your index fund pockets them, reinvests them, and you feel a tiny uptick. It's the same loop we traced with Deere and Tyson, now with rent baked in. Your grocery bill feeds your nest egg. Sounds neat until dinner gets tight. Microstory. A lettuce grower signs a flex lease. Base rent plus a bonus above a price trigger. Year 1 is smooth. Year 2 fuel spikes, boxes cost more, and a heat wave cuts heads. The shipper holds list price with surcharges. Retail rounds up and trims weight in the clamshell. The grower misses the bonus and barely covers base. The landlord logs, rent collected as contracted. The shipper touts, supply chain resilience. The retailer posts, value to members. You pay $14 and wonder why salad feels like steak. Another path. Beef. A rancher faces higher feed and diesel. The packer manages kill hours, quotes cash cattle lower on a short week, and exports high-value cuts at a strong price. Retail pushes pre-ground with a private label. You pay more per pound. The rancher's check doesn't match the chart. Dividends still hit fund accounts because the margin moved, not died. And that silent fee. Data. Every swipe tells retailers what sells. That data sets promos, shelf fees, and private label targets. It also sets forecasts that roll back to packers and growers. Miss a forecast, get penalized. Hit it, get a tighter price next time. The value of the data accrues to the platform. Not the farm, not the cart, the platform. Stakes for real though. If rent escalation, input pricing, and processor fees keep stepping, the only flex is at the farm and the cart. Farmers stretch credit and cut corners to survive. Households trade down, buy less fresh, more shelf-stable. Long-term, that means thinner soils and thicker waistlines. Short term, it means your dollar keeps choosing someone else's yield. So when you hear food inflation cooled, check the sticker, check the size, and check the taste. The dollar still walks the same path. It just learned some new tricks. And on the other end, a fund manager smiles at a steady distribution chart that your pantry helped draw. The family farm squeezed. So let's drop into the kitchen table where this all lands. Input spike first. Seed tech fees creep. Fertilizer jumps on gas. Chemical prices follow. Diesel climbs, then freight. Crop insurance premiums edge up after a bad county year. Meanwhile, the farmer already locked a forward contract last winter because the banker needed certainty. That contract looked smart then. Now it bites. Costs rose. The bid didn't. Cash rent sits there like a metronome. If you're on an institutional lease, it often steps up 2 or 3% a year. No drama. Just up. The owner's debt rolled higher, so the letter says market adjustment. Operators try to push back. But when a fund sets a floor across the county, a neighbor who loses one tract can't risk losing a second. Everyone swallows hard and signs. The squeeze isn't loud. It's relentless. Here's a day-in-the-life math hit. You pre-buy nitrogen in January to de-risk. March storms mess up timing. You need extra passes. Prices moved again. The tender truck is late because the retailer is short drivers. Planting drifts. Your forward contract window is tight, and discounts stack for late delivery. The fuel bill lands the same week as the seed payment. You call the bank. They extend the line, but they want updated projections with the new rent. Your stomach turns. Meanwhile, equipment debt is the anchor you can't lift. Tractors and combines crossed 6 and 7 figures. Even used. Payments don't care about weather. Dealers got you on a sweet rate in the 2000 teens. That balloon comes due. Refinancing now means higher interest and stricter covenants. Miss a maintenance cycle, risk a breakdown. Miss a breakdown, miss a grade. Miss a grade, kiss your margin. So yeah, you keep the tech sub, the software fee, the telemetry plan, because downtime costs more than the subscription. Insurance hikes pile on. Crop coverage is there, but premiums react to volatility. Hail hit last year. County loss ratios went up. Your rate reflects it. Property insurance on shops and storage climbed too. And if the lease requires certain coverage limits, you don't get to shop skinny. You meet the clause or lose the ground. Cash rent bidding wars used to be rare. Now there's strategy. Big operators with outside capital anchor a new normal. A fund wants to consolidate an operating cluster, so they're willing to accept lower near-term yield to secure acres. That sets the comp small, and mid-operators can't match. Pride meets math. Math wins. Exit paths show up in quiet conversations. A neighbor says, "We're tired." Kids live out of state. Health isn't great. The offer covers debt and a house in town. This is how heritage ends, not in scandal, but in math. Some sell and become tenants on a subset of their old acres. Some lease the home place and keep a toe in. Some list the whole thing, park the money, and try to sleep. None of those are shame. They're survival. Demographics push the same way. The average operator is older. Successions are thin because the next gen chased other dreams. Heirs inherit land, not a desire to run 3 a.m. repairs. When probate closes, LLCs appear. A broker calls. A fund is interested. It moves fast because their mandate is deploy. Your local co-op manager hears it first. More acres under new paper, fewer last names on the books. Here's a microstory. A corn and soybean grower runs 5,000 acres, half owned, half rented. Their best rented quarter sits on tile and perfect dirt. The landlord's fund rolls debt. Their letter asks for a 15% jump. The grower can't make that fly. A larger neighbor offers to custom farm at cost if they get the lease. The fund takes it. The original grower loses the quarter. Their planter is now oversized for the remaining acres. Per acre machinery cost spikes. Bank calls. They list 2 owned 80s to right size. At the auction, a numbered LLC buys one. The other goes to a 1031 buyer from the city. The grower survives. Smaller. Tired. The last box closing in his culture. Contracts and compliance replace handshakes. An agronomist tied to the lease prescribes a program that fits the lender's risk model. Used to tweak on the fly. Now deviations need approval. The soil doesn't care about the PDF. Rain comes when it comes. So the squeeze isn't one villain. It's layered pressure, inputs up, rents firm, debt heavier, insurance pricier, buyers tougher. The operator stands in the middle with thin buffer and thinner sleep. And under all of it, there's the hidden asset that decides whether any of this. Pencils, water. Water rights, the real prize. So under all the contracts and spreadsheets, the real fight is simple: water. Dirt without water is a postcard. Dirt with senior water is a bond. That's why every serious acquisition memo starts with a map of aquifers, canals, and adjudicated rights. You can fix a road. You can't summon rain. Farmland value tracks water access more than most folks think. Two fields with the same soil class can trade thousands apart per acre if one has a reliable surface right or a deep, sweet well tied to a stable aquifer. Senior rights, those first-in-line claims set long ago, beat junior rights when rivers run low. In a drought, priority decides whose pump spins and whose crop burns. Funds know this. Senior water rights aren't a perk, they're an explicit strategy. Managers target basins with adjudicated systems where priority is clear. They buy parcels not only for the harvest, but for the paper stapled to the deed. In some cases, they'll overpay for land if it secures a block of senior allocation that can carry a whole operating cluster through lean years. The asset is the acre. The moat is the water. Stakes. For farm families, losing priority means losing a season. One dry summer without allocation can kick a good operator into a fire sale. For towns, water controls jobs, taxes, and whether a packing line runs. For households, it decides if your produce section is full or spotty. And let's be honest, when taps run tight, whoever holds senior claims sets the tempo for a region. Action. Picture a valley with a century-old ditch company. Shares equal water. Senior shares get first call each season. A private fund starts buying farms that include senior stock. They don't wave flags. They show up as LLCs, close quickly, and keep tenants in place. Over 5 years, they assemble enough shares to anchor delivery to 3,000 acres. On paper, they own land. In reality, they own the schedule. Impact. The next dry cycle hits. Junior users cut back early. Some switch crops. Some fallow. The fund's cluster keeps pumping within its allocation. Yields hold. Their tenants meet processor specs and keep contracts. Nearby growers with weaker rights miss grades and lose markets. Land values begin to split, with water pulls away from without. The fund's appraisal climbs faster than the county average. Meanwhile, drought creates markets inside the market. Water leasing, legal in some districts, lets holders rent seasonal rights to neighbors. Prices spike when snowpack stinks. A fund with surplus can lease at a premium, turning water into its own cash stream. Their investor letter calls it ancillary revenue. For the neighbor who pays, it's survival rent on top of land rent. Policy is the quiet battlefield. Local boards and adjudication courts decide how cuts are shared and how transfers move. Funds hire counsel, attend hearings, and vote their shares in ditch meetings. None of that is shady. It's just well-staffed. A tired farmer with a busted pivot isn't showing up to argue line items on a Tuesday. A manager with a mandate is. Here's a micro-story. An almond grower in a junior district hits 2 dry years. Allocations drop. They buy emergency water on a lease at a price that hurts. They stretch trees, lose a block anyway, and miss a quality bonus. Across the road, a landlord-backed row crop operation with senior rights switches to late corn and melons, keeps their volumes, and even leases a slice of water out mid-season. Same sun, different paper, different fate. There's a darker edge too. In some regions, export crops pull water away from local food in dry years. Alfalfa bales leave the port. Nuts head overseas. That's legal and often lucrative. But when shelves get thin and rates rise, folks notice. Political heat follows. Export bans get floated. Fees get proposed. Lawyers smile. And then there's groundwater. Aquifers once treated like open bars are now getting meters and caps. Sustainable plans roll in. Pumping limits phase down. Fields with deep, high-quality wells and power access hold value. Shallow, salty, or dropping wells stumble. Smart buyers read the hydro maps and grid maps together. If you can't power a pump affordably, the right on paper won't save your crop. Funds bundle water with tech to stretch drops. Drip lines, soil moisture probes, variable rate pivots, and canopy sensors. These tools help, and some landlords foot big parts of the bill. But the biggest edge stays paper priority. An efficient dry field still loses to a wet one. So water rights are the real prize because they turn volatile yields into predictable cash. In a world of rate hikes and climate swings, predictability is gold. And when a few players hold the keys to the headgates, they don't just grow crops. They set terms, seeds, patents, and the input cartel. So once water sets the floor, the next choke point is the seed in your hand and the jug on your truck. This is where a few firms draw the map, and everyone else pays tolls to drive it. Start with seeds and traits. Over the past 20 years, mergers folded dozens of brands into a handful of parents. Think Bayer's crop science after Monsanto, Corteva from Dow and DuPont, and Syngenta under ChemChina. Add BASF in the chemistry lane. Different logos at the dealer, same owners on the patent sheet. When a trait stack, herbicide tolerance, insect control, wins acres, the license sits behind locked glass. You can't swap parts. You buy the bundle. Stakes. If you're a farmer, the seed isn't just genetics, it's a contract. Your planter, your sprayer, your whole weed plan hooks to that trait. Miss a payment or break a rule, and the company can yank access. Try saving seed? Not with utility patents. Enforcement teams watch that hard. For neighbors, trait drift and tolerance shape who wins the fight against weeds. For eaters, input costs push into what you pay, even if you never see the label. Action. Picture a county where water is tight and pigweed laughs at old chemistry. A grower signs up for a new trait stack that pairs with a specific herbicide program. The dealer's pitch includes financing on seed, early pay discounts on chemicals, and a rebate if you hit volume. It also plugs into a data platform that pulls yield maps and spray logs. The insurer loves that. The banker loves that. The landlord really loves that because it lines up with lease clauses about best practices. The first year, weed control looks clean. Yields pop. Great. The second year, resistance patches appear. The rep suggests stacking another mode of action, another jug, another pass, another bill. The package discount makes it feel okay. But the total spend per acre climbs, and the plan is now locked to one supplier's calendar. Miss a shipment window, miss your weed size, and the whole program underperforms. This is how a bundle becomes a cage. Impact. Right away, independent seed guys lose share because they can't access the hot trait. Public breeds exist, sure, but the market muscle is with the stack. Chem programs harden. Retailers align their shelves to the dominant crop plan because that's where finance and rebates live. At scale, the region's biology shifts to match the chemistry. Costs set a new normal. Margins thin unless prices stay high. Prices rarely stay high at the exact right time. Then there's the patent wall. Traits extend protection well past the old plant variety rules. Companies police it. Farmers sign technology use agreements that spell out how, when, and where seed and chem can be used. Clean seed bins get inspected. A neighbor shares a few bags to help you finish a field. That friendly loan becomes a legal risk. The message is simple. Pay the toll, stay in the lane. Now fold in data. Those planters and sprayers aren't dumb anymore. They record rate, speed, placement, stand, yield down to the row. Platforms promise, turn data into dollars. Sometimes they do. But who holds the keys? Often, it's the same firms selling you the seed and the spray. They aggregate anonymous fields into models that price risk for lenders and insurers. Those models boomerang back as preferred practices baked into financing and crop insurance discounts. You want the better rate? Run their playbook. Deviate and your banker frowns. Your landlord points to the lease. Your insurer bumps your premium. Here's a micro-story. A wheat farmer wants to try a heritage line on one pivot to cut input bills and chase a niche mill contract. Their lease requires approved seed and a chem plan tied to insurer rules. The banker warns the heritage line won't score well on the risk model. The processor contract wants volume that heritage can't hit this season. The trial dies in a meeting, not a field. Everyone is polite. Innovation loses. Financing tightens the loop. Many retailers offer seed and chem on terms. 0% until harvest, then it flips to a rate that's ugly if you slip. The carrot is huge. The stick is bigger. Miss the date, and your seed access next year gets shaky. The landlord hears about it because the dealer serves both. You juggle cash to avoid a domino collapse. Insurance adds one more belt. Some premium discounts require specific practices, even specific trade-adjacent steps. It's framed as risk reduction. It is. It's also sales. The safer you look on paper, the less room you have to color outside the lines. Try cover crops that don't fit their map? Might need a waiver. Try a non-GMO contract? Expect to argue that the price premium covers their modeled risk. Sometimes you win. Often you don't. And the enforcement isn't just letters. Investigators take samples. Lawsuits happen. Most settle. The lesson spreads fast. Seed saving fades. On-farm breeding retreats to hobby scale. University lines struggle to find acres in a commercial system tuned for traits and tight windows. So the input cartel isn't a secret handshake. It's concentration plus contracts plus data. The power sits in patents and platforms that turn choices into checkboxes. Farmers still choose, but the menu is preset. The American diet item pairs with a payment plan. So here's the gut punch. When the same money owns the fields, the inputs, the plants, and the aisles, our diet stops being about taste or health. It becomes a portfolio. Calories turn into cash flows. And that pushes what fills your fridge. Look at what actually fills plates now. Ultra-processed foods, boxes, bags, bottles, win shelf space because they scale, store, ship, and margin better than a peach. They're built from cheap base crops turned into stable ingredients. Corn syrup, soy oil, refined wheat, protein isolates. A few massive firms make them, and the same passive funds sit on their cap tables. That's not a moral lecture. It's just how the math steers the menu. Shelf space isn't democracy. It's pay to play. Slotting fees by eye level. Promotions by end caps. Private labels copy the winner and squeeze cost. A small brand paying real fruit costs can't match that. So you get strawberry yogurt with a whisper of fruit and a chorus of stabilizers, because the stabilizers protect margin and the fruit rots on trucks. The balance sheet loves shelf stable. Now layer on the buzzwords. ESG decks talk soil health, fair sourcing, climate pledges. Good goals. But check farm gate prices during the speech. If a grower bonus doesn't show up in the contract, it's marketing, not money. Cover crops cost time. Regeneration takes years. A brand can pocket a sustainable premium without paying the farm a dime more if the certification window is loose and the story sells. Healthy premiums are the candy shell. High protein this, keto friendly that, low sugar but sweetened with a new acronym. Those higher unit economics flow to the brand and retailer. Farmers still get commodity checks tied to bulk grades, not health claims. A better for you cereal might use the same corn. The claim lives in the processing and the pitch, not in the field. Here's where it gets crazy. Data decides dinner more than cravings do. Loyalty apps learn your habits. Retail AI nudges you from a brand to a private label. That switch preserves margin upstairs. It also steers supply back through contracts that demand volume, shelf life, and uniformity. The exact traits ultra-processed food nails. Whole, messy, seasonal food loses. A bruised tomato can taste amazing. It can't survive a national promo. Stakes. For families, this means we trade freshness and fiber for stability and shelf life because the portfolio favors it. Prices stay managed with shrinkflation and coupons that pull you into the center aisle. For growers, niche crops that improve soil, diverse rotations, legumes cover seed for seed, struggle to find steady buyers. For health, we all pay later. Diabetes care isn't in the cereal box price, but it's in the budget. Action. Picture a retailer meeting. The buyer reviews category P&L. Center store is down units but up dollars thanks to premiumization. Produce is volatile. Shrink, weather recalls. The call is simple. Expand private label snacks. Tighten ready-to-eat salads to a few SKUs. Lean on national brands for promo dollars. Upstream, processors optimize lines. Ingredients lock. Contracts stiffen. Farmers planting for diversity hit a wall. The machine hums. Impact. Immediately, what's affordable and visible shifts a few inches each quarter toward longer shelf life, higher margin, simpler logistics. Over a year, a kid's lunchbox changes. Over a decade, so do lab results. The index funds tracking all this call it quality earnings. Your doctor calls it something else. Now the midpoint question. Can we actually escape a system we unknowingly fund? You pay through your cart. You cheer when your 401k grows. You might even own a slice of a Farmland REIT in a dividend ETF. Unplugging feels like sawing the branch you're sitting on. That's the trap. Get this. Escape doesn't mean going off-grid and churning butter. It means changing who gets your grocery dollar and what that dollar signals. Direct from farm buys, co-ops that pre-fund crops, local mills, meat shares, CSAs. Those moves turn calories back into relationships and break one link of the portfolio chain. Not all of it. Enough to matter. But let's be honest. You can't shop your way out of policy or market power. The lattice is wide. It sits in water boards, in patents, in proxy votes, in how indexes define the market. So yes, shift spend. Also, push the levers that set the rules of play. Disclosure on land ownership, fair contract terms, slotting fee transparency, seed patent sunsets, water priority guardrails. Microstory. A city block forms a buyer group. They prepay a farm for a season of veg and eggs. Prices aren't lower every week, but waste drops, meals shift fresher, kids learn what seasons are. The farmer cuts a bank line because cash comes early. No slotting fees. No shrinkflation. One tiny loop closed. So we sit here mid-story, with dinner run like an asset. The portfolio logic one. For now, the question isn't whether the machine exists. It's whether we feed it or reroute a slice of the flow. Regulators were supposed to hold that line. Did they? Let's see who opened the side doors and why they stayed open. Policy loopholes and quiet lobbying. Regulators were supposed to hold the line. So why does the door feel propped open with a brick? Follow the paper. It starts with the Farm Bill, the giant that sets who gets paid, insured, and buffered when weather swings. On stage, it's family farms. In the fine print, big operators with sharp counsel capture the bulk, because payments scale with acres, history, and risk models they can optimize. Subsidies aren't bags of cash, they're guardrails that tilt the road. Crop insurance is the big one. Premium support lowers the cost to hedge. That's good, but the design favors scale. If you run thousands of acres with tight records, you price risk better and collect steadier. If you're small and diverse, the models don't love you. So money flows toward uniformity and bigness. That wasn't the slogan. It's just how the spreadsheet drives. Then come the tax tools. Section 1031 exchanges let sellers roll gains from land into new land, tax deferred. That keeps big portfolios growing without the capital gains hit. Good for continuity, but it also juices bids. Carried interest sweetens private equity payouts when they flip clusters or exit funds. Property tax abatements pop up when counties court investment with upgrades like pivots and roads. These aren't scams. They're lawful levers that tilt the table toward capital that plans ahead. Corporate transparency has its own shadow. LLC layers, perfectly legal, mask ultimate control from public view. You can pull deeds all day and still not see who sits at the top. That makes community debates foggy. Is this landlord and neighbor consortium or a fund 3 states away? The mailbox won't tell you. The auctioneer won't either. Antitrust, meanwhile, keeps tripping on AG mergers. Courts like consumer harm tests. If prices don't jump tomorrow, or if a brand can argue efficiency, deals slide through. Seed and chem rolled up for years under that banner. Processors too. Even when enforcement tried to push back, remedies were slices and spin-offs that didn't rebuild real competition on the ground. So the middle stayed thick and the farm gate stayed thin. Contract rules lean the same way. In many markets, buyers write terms that let them grade hard, reject late, and shift freight. Growers sign because the alternative is no market. Laws exist to check unfair practices, but proving harm takes time and lawyering farmers can't afford. Quietly, those contract norms migrate into leases, insurance, and bank covenants. The web tightens. Lobbying isn't a cartoon. It's breakfasts, drafts, and technical assistance on bill text. Trade groups that sound mom and pop often carry the water for the largest members. Letters arrive with hometown logos and national talking points. The pitch is stability, competitiveness, feeding America. The ask is always nuance, a definition here, an eligibility tweak there, a modernization of reporting. Each small carve-out lands fine. Together, they write a system. Here's a microstory. A state debates a bill to disclose beneficial owners of farmland above a threshold. The hearing fills with folks in seed caps. Behind them, counsel with crisp binders. Testimony warns of compliance burdens on families and threats to privacy. A proposed threshold lifts. Exemptions appear for pooled vehicles under oversight. The final law catches small local LLCs and misses the biggest structured buyers. Everyone claps for transparency. Not much actually changes. Water boards are another quiet gate. Elections happen in off months. Eligibility ties to acreage or shares. Funds show up with votes packaged inside the land they bought. Meetings set allocation rules, transfer terms, and metering schedules. The agenda sounds dry. The outcomes decide who farms. A tired operator misses 2 meetings and learns the rules secondhand. A manager with staff never misses. On the federal side, proxy voting policies at giant index funds shape boardrooms. Stewardship teams publish principles, climate risk, board independence, pay alignment. Solid stuff. But when push meets price, long-term value can read as protect margins. Votes against aggressive anti-competitive stances are rare. Pressure to chill slotting fees? Muted. Support for stronger supplier fairness? Case by case. The default is status quo with ESG gloss. Transparency gaps keep citizens guessing. USDA reports show broad patterns. Family farm counts, production shares, but don't pierce LLC veils. States vary on foreign ownership lists, often mixing national security talk with little usable data. Meanwhile, private data vendors sell parcel-level intel to funds and retailers. Asymmetry grows. The public debates vibes, capital reads dashboards. So what now? Close loopholes that reward flipping and overlevered roll-ups. Tie crop insurance discounts to real soil gains that pay farmers cash, not just scorecards. Cap or daylight slotting fees, so reach isn't bought in the dark. Sunset seed patents on a shorter clock to reopen breeding. Require beneficial ownership disclosure for large landholders, no carve-outs. Strengthen packers and stockyards' teeth, so contracts can't offload all risk. And put water elections on calendars people see. This isn't anti-investor. It's pro-balance. Food is a system we all sit inside. Rules decide who carries risk and who clips coupons. Right now, risk piles at the farm and the cart. Quiet lobbying made it that way. Loud, boring fixes can move it back. Stress test, what breaks in a shock. So let's hit the system with real shocks and see what snaps first. Start with rates. Cheap debt from the 2010s got rolled into big stacks, bank loans, mezz, maybe bonds. Then rates jumped. A 5-year note at 2.8% comes due into 7%. The fund's pro forma bends ugly. They've got 3 levers: sell ground, cut investor checks, or raise rent and fees. Guess which letter the tenant gets. Stakes are obvious. A rent hike mid-cycle shreds thin margins. A sale can uproot a tenant if the new owner wants different terms. Cutting distribution spooks investors, slows new money, and pressures managers to optimize everything else. Leasing fees, water leases, even charging for data access. The farmer becomes the shock absorber for a choice they didn't make. Action. A leveraged farmland fund hits a refinancing cliff. Lenders demand higher DSCR and a fresh appraisal. The manager pushes appraisers to bless value adds, tile, pivots, solar easements. Rent letters go out with market alignment language. Flex leases shift to higher bases, smaller bonuses. Tenants scramble, shed a marginal quarter, push draws on operating lines. A neighbor folds early and sells equipment at discount. The fund survives. The county feels it. Impact. Overnight, comps reset higher on the stabilized parcels and lower on distressed sales, splitting the map. Banks tighten. New buyers with cash feast on auctions. Small operators lose scale, which lifts per acre machinery costs. That's the first crack. Now climate shocks. Think back-to-back heat domes, surprise frosts, or a stalled storm that floods a valley. Crop insurance pays, but not like a miracle. Indemnities arrive months later and don't cover the full stack. Lost quality bonuses, overtime, emergency fuel dockage. Premiums then ratchet up next year because loss ratios spiked. Insurers pull back in certain counties. The farmer's safety net frays, just as inputs creep again. Stakes. Climate hits don't only cut yields, they blow up timing. Contracts penalize late. Retailers swap SKUs. Processors retool. A grower might hit volume and still miss grade, losing premiums they baked into survival. The insurer's check softens the fall, but bank covenants don't pause. Action. A late heat wave slams tomato fields. Solids drop. The processor enforces the quality clause and pays a discount. The grower misses a landlord bonus on the flex lease and files an insurance claim. The fund reports whether variance managed, still collects base rent, and highlights drip upgrades in the investor deck. The grocer pushes private label pasta sauce with a smaller jar at the same price. Impact: cash crunch hits at harvest. Repairs get deferred. Labor hours cut. Seed orders shrink. The next season starts behind, which raises the odds of another stumble. That's the second crack. Supply chain outages are quieter but brutal. One plant down, fire, cyber labor, creates a choke point. Livestock backup. Produce misses windows. Freight bids spike. Contracts may have force majeure on the buyer side, not the farm side. The cost lands downhill. Action: a major packer's line idles for 2 weeks. Cattle sit longer. Feed costs jump. Cash prices sag. The rancher bleeds. The packer offsets with exports and premium cuts when the line restarts. Funds holding packer stock cheer. Operational resilience. The rancher sells late at a worse price to clear pens. The retailer keeps ground beef high because shoppers expect it now. Impact: one outage reveals how thin the slack is. Regions without redundant plants discover their price takers to a single dock. That's the third crack. Food inflation spiral is the next layer. Wages chase prices. Brands defend margins. Retailers lean on shrinkflation and private label. Central banks keep rates tight. That loops back into the refinancing pain we started with. The system starts eating its own tail. Action: a cereal maker hikes price, blames inputs. Retailers demand promo dollars to keep volume. Farmer doesn't see a better corn bid. Pension statements hold steady from dividends. Households switch to cheaper calories, often worse for health. Impact: diet shifts, soil budgets shrink, local shops close. Risk migrates to the edges, farms and families, while the middle protects EBITDA. Then politics. Scarcity brings heat. Export bans get floated. Windfall taxes pop up. Price controls make a cameo. Water transfers face moratoria. Foreign ownership bans broaden, but mostly catch small LLCs. Funds lawyer up and adapt. Farmers caught mid-plan eat policy whiplash. Here's where it gets crazy. The shock map is uneven. Operations with senior water, low leverage, and strong local buyers bend and don't break. Highly levered clusters on junior water, hooked to one processor, snap fast. The same county can hold both fates, side by side. So what breaks? Trust first, then credit, then corners of the map where paper outran weather. In the aftermath, we either double down on consolidation to stabilize, or we spread risk with more local control. Reframe the stakes now. This isn't investor pain or farmer pain. It's household survival when the coupon pads out of feudal farm. Fridge. So how do we break this without breaking dinner? We don't need a revolution. We need a relay. Move dollars, votes, and data from the choke points back to the people who grow food and the towns that keep them alive. Start with local co-ops and CSAs. Pre-fund the crop. Pay a farm in March for boxes you'll pick up June through October. That early cash replaces bank lines and retailer terms. The farm plans smarter, plants tighter, wastes less. You get food that tastes like something. Prices aren't always lower, but value is higher because shrink drops and middle fees vanish. Stack meat shares on top. Split a half beef or a whole hog with neighbors. Pay one butcher, not 5 brands. Freeze what you don't cook this week. Per pound cost beats the store on quality cuts, and the rancher keeps margin that used to leak to packers and freight. Same play works for poultry, cheese, even grain from a regional mill. Land trusts are the slow, strong lever. Instead of another flip, fold acres into community ownership. Farmers get long leases with fair clauses and renewal rights. Rents track soil health and real markets, not cap rate targets. Donors throw in monthly pledges, $20, $50, that stack into real capital over years. Every trust acre is one less lottery ticket for a numbered LLC. Here's where it gets practical. If you can't buy land, buy time. Help a farmer refinance a nasty note through community debt. Local CDFIs do this. Church treasuries do this. A town credit union can float a packhouse upgrade with terms that match harvest, not Wall Street. Terms beat rates when the calendar makes or breaks you. Regenerative practices only scale if risk drops. So Thai soil moves to real money. Co-ops can underwrite micro-bonuses for cover crops because they see the yield stability. Landlords can write flex leases that pay a premium when organic matter climbs. Insurers can cut premiums for proven rotations that reduce losses. Make the practical choice the profitable choice. Farmers aren't allergic to change. they're allergic to roulette. Bypass the choke points with transparent markets. Regional hubs that handle wash, pack, cold, and delivery let small and mid-farms sell into schools, hospitals, and restaurants without eating logistics. Post prices, post grades, post on-time stats. When everyone sees the rules, side deals fade and trust grows. Software here should be boring and open, not a lock-in platform. Water needs its own commons. Organize basin co-ops that pool rights and invest in efficiency for all members, not just the biggest. Vote as a block in ditch meetings. Push metering that shares real data, flow drawdowns, so panic doesn't run policy. Build drought plans in wet years. Senior holders can lease a slice at fair caps to keep neighbors alive. That's stability you can't buy on a spreadsheet. Now the pension loop. Your retirement money sits inside the same funds squeezing margins. Use proxy power. Many plans let you pick ESG or stewardship options that still track broad markets, but push for supplier fairness, slotting fee daylight, and longer supplier payment terms. File comments. Join plan committees. Ask for policies that oppose land grabs with weak tenant protections. It's boring. It works. Demand tenancy terms from any fund you invest in. If a farmland opportunity can't show lease templates, flex metrics, water policies, and soil targets with cash bonuses, walk. Good managers already publish this. They'll welcome the ask because it separates them from extractive players. For real though, shop strategically. Shift 10 to 20% of your cart to direct channels. Lock seasonal bulk, tomatoes for sauce day, apples for sauce and chips, flour by the bag from a mill you can visit. Split a freezer with a friend. Build habits that turn into demand signals suppliers can plan around. Cities can help without writing checks. Change zoning to allow corner stores to run as co-op pickup points. Open school kitchens after hours to prep CSA packs. Waive silly fees on small delivery trucks. Post city agency bids for produce in advance and break them into chunks small farms can hit. You're not subsidizing dinner, you're sanding the friction. Tech should be hands-on, not extractive. Farmers own their data. Platforms can host, sure, but rights to share need clear, revocable terms. Co-ops can host their own stacks so lenders and insurers still get enough to price fairly. The goal is better decisions, not another toll. Microstory. A Midwest town loses 2 dairies in 3 years. A school food director flips the script, signs a 2-year deal with a nearby creamery, pays a fair floor, and runs a milk share for families on EBT with local grants. The creamery upgrades pasteurization with a community loan. The farm stops selling cows. Kids drink milk that didn't ride 4 states. The town keeps the tax base. Policy pressure doesn't need pitchforks. Show up at water board elections. Push state. Laws to publish beneficial owners for big land blocks. No carve-outs. Back bills that cap slotting fees, or at least put them in the open. Shorten patent life on traits so public breeding can catch up. Tie crop insurance discounts to tested soil gains and pay farmers cash for hitting them. None of that is radical. It's balanced. Let's get hustling. Pick one thing this month. Join a CSA, split a meat share, move your bank account to a credit union that funds local AG, or email your pension about proxy policy on supplier terms. Small moves stacked together beat one big speech. Trust me on this one. Been there, done that. Actionable steps. Take control of your food spend. All right, game plan time. No perfect fixes, just moves you can make this week that stack into real change. Pick a few. Build from there. Money is a vote, right? Let's vote smarter. Shift 10 to 20% of your cart to direct from farm. Start with a CSA. Search your Zip Plus CSA, or ask your farmer's market. Pay up front if you can. If not, many offer sliding scale or snap matched. You get boxes that force you to cook again. Farmers get early cash to buy seed without credit. Less waste, more flavor, fewer middle fees. Lock seasonal bulk. 1 tomato day in late summer. Buy a lug from a farm you can name, cook sauce, freeze or can. Same for apples, sauce, chips, butter. Onions, potatoes, winter squash? Buy a case, stash cool and dark. It's work, sure, but the per pound cost drops, and you cut 4 store runs you didn't need. Do a meat share. Split a quarter beef or half hog with 2 neighbors. Ask the butcher for a cut sheet help. You'll learn fast. Price per pound for real cuts often beats the store, and the rancher keeps margin that used to leak to packers. If freezer space is tight, Try a monthly subscription from a nearby farm. Not a meal kit, an actual farm. Form a buyer co-op on your block. 5 families, 1 group text. Rotate pickups from the farm stand or hub. Pool orders for a discount. If the farm needs prepay, write simple terms. Refunds only if crop fails. Keep records in a shared sheet. This is way less fancy than it sounds. It's carpooling for food. Pick a mill. Flour is a sleeper move. A 50-pound bag from a regional mill cuts cost, tastes better, and bakes different. Split with a friend. Same idea for beans and rice from a US grower. Dry goods are where shrinkflation hides. Beat it with a sack and a bucket. Choose 2 packaged staples and go private label on purpose. Not to help retailers, but to free budget for direct buys. Trade 1 fancy snack for a CSA add-on like eggs or mushrooms. This is hedging. Move dollars from high-margin ultra-processed to high-impact local. Bank where farms bank. Credit unions and community banks fund pack houses, coolers, and lines of credit. Move a checking account. Ask what AG loans they do. If the teller blinks, that's feedback. If they smile and name 3 farms, you picked a good one. Invest with managers who publish tenancy terms. If a farmland fund hides lease templates, water policies, and soil bonuses, pass. If they show flex terms, renewal rights, and soil pay, consider a small stake. Demand proxy voting that pushes supplier fairness, slotting fee daylight, and on-time pay. Your retirement plan often has a stewardship option. Ask HR. No joke, 1 email can shift millions quietly. Support land trusts monthly. $10 counts. $20 compounds. They buy acres, take them off the flip table, and lease long-term to working farmers. If you've got skills, legal, accounting, GIS, offer a few hours. Time is money here. Watch water boards. Put their meetings on your calendar. Vote. If eligibility is weird, help a neighbor eligible to vote. Ask about allocation rules, transfer caps, metering plans. A polite question on the record shapes policy later. Map your local. Comment your zip in city groups and build a shared map. Farms, co-ops, hubs, mills, butchers, dairies. Keep hours, order minimums, and pickup rules current. New folks won't try if the first attempt is a miss. Make it easy. For real though, cook 2 anchor meals a week. Big pot beans, roast chicken, sheet pan veg. Stretch into tacos, wraps, soups. Direct buys shine when you actually cook. It saves cash. It builds habits. It tames chaos. Schools and offices are leverage points. Ask food service to pilot 1 local item weekly: milk, apples, salad mix. Directors want steady supply. Offer to help connect farms to hubs. If your office has snacks, swap 1 brand for a local option. People notice. Track 1 product's price and wait for 3 months. Take photos. When it shrinks, email the brand. Copy the retailer. Post politely. Patterns hate light. You'll also catch when a farm price holds steady while a brand jumps. That teaches fast. Host a freezer party. 3 friends, 1 afternoon, 10 family meals. Soup kits, marinated cuts, veggie packs. You buy bulk from a farm, split labor, freeze flat. Next month, swap recipes. Food is social. Glue. Use it. Last, pace yourself. Don't torch your budget or time trying to be perfect. Move 10%, then 15%. Then set 2 calendar reminders. Spring sign-up, fall bulk. That's it. The system counts on drift. You beat drift with small, steady moves. Let's get hustling. Pick 1 step today. Text a neighbor. Email your HR. Search your zip. Put cash where it feeds people you can name. Trust me on this one. The first box shows up, and dinner just feels different. Meaning and stakes. Who owns your calories tomorrow? So here's the straight line through all of this. Ownership sets price, choice, and what survives when shocks hit. Not just who holds the deed, but who writes the lease, who owns the water, who sets the contract terms, who votes proxies at the board table. That lattice decides dinner when the weather turns mean or money gets tight. Feudalism used to be castles and lords. Today it's contracts and dashboards. The landlord is a fund. The moat is a water right and a data platform. The tithe is rent, slotting fees, and a rebate you never see. You don't bow at a gate. You tap a card. Same transfer, cleaner UX. If we keep drifting, here's the path. Fewer farmers, bigger units, tighter inputs, heavier debt. Soil's thin because rotations chase cap rates. Water policy tilts to whoever shows up with counsel and shares. Shelf space keeps paying for stability over nutrition. More ultra-processed, more private label, less room for messy, fresh, seasonal. Prices feel managed, but never forgiving. Your cart funds margins upstream, and the check at month's end bites a little harder. If we act, the map bends. More local control isn't a slogan. It's leases with real flex, water boards with voters who farm, and buyers that pre-fund crops. It's schools and hospitals locking steady orders from hubs that post prices and grades in the open. It's land trusts that pull acres off the flip table and give farmers time to breathe. It's proxy policies that stop rewarding bottlenecks that squeeze growers and start pushing boards to pay on time and publish slotting fees. You won't feel it like a parade. You'll feel it when a box shows up full and on time, when a farmer says yes to planting clover because the lease pays for it, when your kid eats a peach that tastes like summer and costs less than a protein bar. The next decade sets the map for a generation. Water cuts are coming in more basins. Refinancing cliffs don't care about nostalgia. Climate is noisy. If ownership stays opaque and contracts keep shoving risk downhill, shocks will spill into empty shelves and ugly politics. If we spread risk, more owners, longer leases, fairer terms, open books, the same shocks look like bumps instead of cliffs. Stakes are real at the household level. Food is the one bill you can't skip. When rent and inputs march up, the only flex left is diet. Cheaper, sweeter, shelf-stable. That's a health tax paid later. When local farms fold, towns lose more than romance. They lose tax base, kids, and a reason to stop on Main Street. When water rights consolidate, a valley's fate can swing on one meeting you didn't know existed. This isn't investor versus farmer versus shopper. It's a design choice. We designed a system where the safest cash flow sits far from the weather and the weeds, and the risk sits on the people who touch both. We can redesign, not by yelling at aisles, but by shifting 10 to 20% of the flow, money, votes, data, toward people and places that make food, not just moves. So ask one question before you buy, bank, or vote. Who owns these calories tomorrow if a shock hits? If the answer is a spreadsheet in a distant office, redirect to slice. If the answer is someone I can name, double down. Small, steady moves write different rules. Every tap at checkout is rent to a landlord you never met, unless you reroute a slice to someone who grows food you can name. Subscribe for more deep dives, share this with one friend, and drop your zip in the comments so we can map your local co-ops and land trusts. Watch the next episode. We trace self-storage and how Wall Street rents your past back to you.